Welcome to episode 86 of Accessible Finance for Retirement. I'm Eric Johns.
And I'm Rachel Johns.
Let's dive in.
So, Eric, I have a number of questions that have been sent that we are going to help answer.
These are fun. Let's go.
Are you excited?
Yes, ma'am.
All right. Question number 1. All my retirement accounts are over 5 years old. My wife and I are over 60.
Okay.
This is likely the last year where I could open a Roth IRA in my wife's name due to retiring in 2025. I'm not sure if I should open a Roth IRA in her name. Is there a future scenario where I pass and the widow would benefit from already having 5 years in a Roth IRA when she inherits mine?
That's a good question. Yes, she would then be able to, she'd be able to roll the account into her name. Let's think about this. She'd be able to roll the account to her name, right? And like, how is that good though? It's a Roth, so there's no RMDs for him or for her.
Mm-hmm.
I guess it just depends on whether or not she cares about the custodian. There's not a huge benefit, I guess. There's not a huge benefit. You don't have to do it. I probably would, just for the flexibility of being able to move custodians or have all the accounts in her name. It might be marginally more annoying for her to gain access to your account versus hers. If you have her account as like the designated beneficiary or like the TOD, well, it's not gonna be a TOD, but it'll be a beneficiary on your account, then I think it'd be a little bit quicker for the institution to just take the money, transfer it out. Yeah, to treat it as her own. But I don't think it matters. 6 1/2.
Excellent.
Sorry.
Question number 2.
Had to think that one through.
You should. These are new. He's never seen them.
Well, that's the
My
idea.
favorite way to do it.
Got to be good at the game, right?
All right. Are you ready?
Yes, ma'am.
Where are you putting your cash? I've been holding about $175,000 in an Ally high yield money market account.
Okay.
But over the last couple of years, the rates dropped from over 4% to 3.5%. I'm looking for someplace relatively safe that would have a better return. By the way, I'm not interested in advice on how much cash I should have or not have.
I like that. The guy knows what he wants. All right. Nothing wrong with that.
He also knows probably what you're about to say.
A little bit assertive there. Unless this question is incredibly old,
It is not old. It was made 2 weeks ago. No,
got it.
1 week ago.
Okay. The Ally money market then is slightly below rate, I would say, in that most money markets are still at like 4.1 or so net of fees. So you could just move to Fidelity, Vanguard, Schwab and have 4.1% yield on the money market. But yeah, that's probably what I do. That's an extra 100 basis points, right? He said he was down to 3. Is that what he said? 175K?
He said he went from over 4 down to 3.5.
I mean, I haven't looked at the money market this week, but I mean, interest rate expectations, there's an 80% chance of the Fed CME tool that they're going to cut. So maybe the money markets usually don't move ahead of that though. So I would have to go Google SWVXX current yield.
It's just tough because I think the options when you're trying to hold something in cash are
typically money market's fine. Money market's usually the thing we would recommend. So to the extent that Ally's money market's usually par like with everybody else, like if he said he was over 4 or a little at 4, he's probably still in the ballpark of reasonability. I don't know that I would make a huge change based on, a few basis points.
Yeah.
Probably not. I think you're fine. Keep doing what you're doing. Ally money market's fine.
All right. Number 3, you ready? I'm getting close to retirement and I've spoken with a few advisors, but I'm hung up on the fees. It seems that the ones that charge AUM of 1% seem more active in the investments, while some of the flat fee people seem more passive. In other words, the AUM seem to tweak and add/remove segments based on markets and environment. But I've read many times that most cannot be investing in S&P or a total stock market. That most times it's better to do S&P or a total stock market. So is active really better? All the other services seem similar. They all do rebalancing, etc. I guess I'm just looking for thoughts on active versus passive, as it feels like it's a big difference in fees.
Boy, this is such a great question. Fantastic question, first of all. Where do we start? So I've listened to so many podcasts. First, shout out to. Oh, sorry.
Go shout out.
I was just going to say shout out to Rational Reminder podcast. If anybody who's really interested in super granular discussions, I mean, nobody's really going to want that, but it's my favorite. It's so good. Ben Felix is just the man. The guy is great, and the pursuit of knowledge. I hope so. I love the guy. He's great. The pursuit of knowledge on that podcast, in my mind, is second to none. Right? Like they're strictly speaking to academia. They only care about like objective data-driven results and conclusions based on those data-driven results. So like academic peer-reviewed studies, papers, everything else. This is a long-winded way of saying there's a huge, vibrant conversation about active versus passive right now. Mm-hmm. Even the passive funds that you might think of as completely passive, like VOO, for example, like a Vanguard S&P 500 ticker, you would say that like they still have to make decisions. They have to decide when they're buying IPOs, and they negotiate directly with the issuers of the IPOs, which I found out recently on one of their podcasts, when they interviewed Vanguard's CFO and or CIO, and then their chief research officer, so CRO and CIO. And they get to negotiate those on their IPOs, but they have to decide when are they going to rebalance. Are you going to do it quarterly? Are you going to do it monthly? How are you going to rebalance? Like, you know, like how are you going to buy international? Like, what are you thinking about when you do that? What's included in the indexes that you're tracking? Mm-hmm. How thoroughly are you going to, like, there are a number of decisions that even these passive funds that are really just they're just trying to copy the index, but they still have to make decisions, right?
Now, to be clear, he was not being critical of the
index funds themselves.
Yes.
No, he wants index funds.
It was, the concern was the change in the fees charged by the financial advisor, mm-hmm. right? And so I think that he said, you know, what I've found is that those charging AUM fees are more actively managing funds, and those charging flat fees are more passively managing my investments.
Got it.
Okay. And so I think the idea there is that while that may be his experience, there are people who are charging AUM who are
also not doing anything
or passively doing investment management. There are people charging flat fees that are actively managing things. So while his experience may be like active equals AUM, passive equals flat fee, that would be just not accurate.
Correct. That's fair. That's a false dichotomy there. I agree. So I would say that it's difficult because I think the question under the question is like, how is this active management actually going to justify the 1% AUM fees, right? Like how are you going to beat the market? And you know, we get that question a lot. Like a prospect will sit with you and you say, like, okay, your fee's 1%, whatever. Like we'll just use 1% because that's what he used, right? Yeah. So your fee's 1%. So that means you're going to beat the S&P by 1%, right? And we're like, whoa, no, absolutely not. We're not going to guarantee any returns, right? We cannot do that. From a compliance perspective, you can't do that, period. But to be objectively clear, like, no, that's not even the goal. Right? Like, we're going to be participating in the markets to the extent that you're comfortable with, that it meets your risk tolerance and risk profile and everything else.
Really quickly, the goal is certainly to save more than the fees.
Correct.
We want that's not the goal.
No, we're just here to pocket the fees and let you lose. Like
the goal is definitely to put the people that the clients are working with
in a better position. 100%.
Without a doubt.
So I would say
ways to do that though.
Correct. I believe that the ways to do that are tax alpha, helping keep the clients in the seat, right? You might think of that. So like a lot of it is considered is behavioral finance to be honest with you. So it's education on markets that are going to help provide comfort. The idea that somebody that's a professional and does this every day is actually watching these things every day and, you know, staying up to like, hey, is a crypto market actually a viable, you know, investment strategy? Like, how good is that right now? Like, should we be all in AI stocks? I know a coworker of mine had a 300x return on, you know, insert AI company here.
I think that's what it is. I think that it's so real. It's so tangible to see how impactful investing in a stock that has just shot to the moon has been.
Or Bitcoin.
That people, I think the general public tends to believe that the biggest area where they are going to make money is through their investments, right? But the goal with your investments is to keep up with inflation, right? To follow the up and to the right over time.
Right.
And I think that because the things like tax law, withdrawal strategies, I think all of that is so confusing. It's so granular that it's a lot harder to have a firm grasp on how much money can be lost or saved by making mistakes or smart choices in those arenas.
Right. So just succinctly, I would put, again, this is a fantastic question. I feel like I could speak about it for hours, but I would say that you would want to look for an advisor or firm whose investment philosophy aligns with yours, right? And that does not mean, like, if they're charging AUM and they're using mostly what you would consider passive funds, I don't think that's a bad thing. Like, I would actually argue that that's a good thing, right? And then even some of like the more active managers in the space, like DFA, you would hear Dimensional Funds and Avantis, which is kind of a spinoff of DFA. They could be considered active. What they're doing is actually curating the lists of like broader index funds into what they would track because they feel like their valuation metrics are better and the timing around the rebalancing creates less arbitrage opportunities for institutional investors. So this is all like granular stuff that we could probably get into if you wanted to talk about it. But I would say that you want your investment philosophies to align. You're looking you should always be looking to work with a firm that is going to generate value for you in excess of their fees. But the way that they're doing that should not necessarily be linked just to outperforming the market. Mm-hmm. It should be in putting you in the portfolio that meets your risk tolerance so that you're not jumping ship when you shouldn't be. And you're looking for tax alpha, essentially, right? Like changes in tax rates over time and what you're paying and how you're getting the money out of the account. Because really all you should care about is your after-tax balances. If you have $10 million pre-tax and you're only going to get $2 million after tax, that should be viewed as only $2 million after tax versus if you have $10 million pre-tax and then you're somehow able to get like $4 million.
Sometimes you get blinded by the number on the account without realizing how much of it's mine and how much of it belongs to the government.
Right. And I'm just using I'm just pulling numbers out of the air. But the point is, most people have huge pre-tax balances and aren't quite sure about how the mechanics of this all work and how these pieces fit together. So, there's again, tax planning, estate planning, retirement planning. How are you taking the distributions? When are you taking the distributions? RMDs, Social Security. There's a lot of granular things that will be coming together there, converging, Medicare. You've got insurance planning. Should you get life insurance? How much should you get? Like these things holistically should be accounted for. And I would say that in general, well, I can't say in general, but I would say that you want to be sure that you're gaining access to all of these areas that you feel like you need access to, right? And I would argue that most people do need access to all of these areas.
Correct.
So look for value in excess of the fees for sure. And it's just a question of, can that advisor provide the value and articulate the value that he or she is going to be providing in excess of those fees?
Oh, yeah, that's shaping.
Yeah, for sure. There's some great advisors.
I know.
Fantastic.
Okay, so our last question for this episode. I have a Roth conversion question. I did my first Roth conversion earlier this year, moving $50,000 from my IRA to my Roth. I am planning on paying the taxes out of my high-yield savings account, but have not done so yet. I was planning on paying when I do my normal taxes, but now I'm afraid I may have made a mistake. Am I supposed to file a quarterly withholding with the IRS when this is done? And if so, do I have time to file so I don't get penalized next year?
It's a fantastic question. Let's first add all the relevant disclaimers. This is not tax advice. Please don't construe any part of this as tax advice. Please consult your tax advisor or tax preparer.
Hypothetically talking about this.
Right. Let's just educate you a little bit on how this works. Yeah. So you could potentially be subject to timing penalties. It depends, right? So on the amount of taxes you owe, on whether or not the tax payments are being withheld from your W-2 or if you have other sources of income or distributions. If you withheld the taxation from your, how old did she say? Did she say?
Nope.
Okay, we don't know.
So there were questions asked in response to this and the original poster did not
elaborate. Yeah. Got it. So real quick, if you missed your deadline, like I'm not exactly sure when this 50K was converted, but if it was in Q3, then the deadline for the estimated payment there is September 15th. So you still have time. You can make that. Alternatively.
Now, so the post was made, we're in August.
Sure.
The post was made this week.
Okay.
So when they
you have time.
They said it was made earlier this year. So
I see. It could have been January 1. Sure. Let's assume it's January 1. Okay. Let's assume it's January 1.
Yeah,
worst case scenario.
Worst
case scenario, you converted 50K January 1. You didn't pay any tax on that. Yeah. And do they have a job?
Not that they specified.
Okay.
Possible.
Okay. If they have a job, right, where they're going to have withholdings, they can withhold from their W-2 even on their last pay statement, right? Like obviously you're not going to have substantial enough gross wages to be able to withhold all of it and have that substantiate your entire tax bill.
Increase their withholdings for the rest of the year
to
make up for where
exactly
the
correct.
Are here.
Exactly correct. So your withholdings that you have at any point in time, including December 31st, are counted as if you paid them in on January 1st. Because the IRS has no way to know when those taxes were actually withheld. They treat it
through W-2.
Correct. Or any other firm that's going to pay, that any other way that you're going to be paid that's going to withhold taxes for the government. It could be your own 1099.
What if our Roth converter is not working?
If our Roth converter.
Yeah, the person doing the Roth conversion. Like, what if this person did not?
Oh, is not working. What are they going to do? Well, they're probably just going to pay the taxes now, and they're going to owe. It's just going to be interest. Like, you're going to pay at the federal, what is it, AFR rate, applicable federal rate, I believe it is.
So the sooner
it's
that they're
specified.
paying like, let's say it was January 1 and
Yes.
they're not working.
They're going to be treated as
yesterday.
Correct. They're going to be treated as having underpaid for the period of time that, essentially. Correct. Exactly. So for every month or quarter that they've underpaid, they're going to be assessed like some percentage, a quarter of the AFR, the applicable federal rate. And then they take that to the amount that is considered underpayment. They're going to tack that on. It shouldn't be nonsensically expensive. It's not going to be all that different than the prevailing federal funds rate, which means that if you had the money in a high yield savings account, like you said, then you're probably not even losing that much, right? You might be generating 4%. You're paying 4.25%, 4.5%. So like it's kind of a wash.
Said, am I supposed to file a quarterly withholding with the IRS? So the answer there would be no, correct? Because it needs to be paid in the quarter if you're not having it withheld from your W-2.
If you're not having it withheld, you would just make an estimated quarterly payment. To be honest, I'm not familiar with a quarterly withholding.
Well, I'm assuming that's.
If they mean quarterly estimated payment, then yes, just make an quarterly estimated payment due to the amount that you're going to use. Use your tax preparation software, probably like use Free Tax USA, TurboTax. We use Solicitaplan, but that's planning software. So use your tax preparation software to know what your total tax liability is, and then you can adjust your withholdings so that your total tax liability is withheld by December 31st, and you will have no issue, regardless of the timing of the payments, regardless of the timing of the earnings. Okay, does that make sense? So if I can make sure that my total withholdings on my W-2 that I'm going to receive, at the beginning of the next year, are sufficiently covering the entirety of my tax liability. Really, if they cover 90% of my tax liability, I'm good. If they cover 100% of prior year, if I make under 150,000, or 110% if I make over 150,000, then I'm covered as well. So that's all fine. You can avoid the penalties that way. There are still
there's an added perk there if you are still working and having taxes with.
Correct. That's for tax payment penalties, but the timing could still apply. The W-2 withholding is, if that is sufficiently covering your tax liability, you're good to go, period. Does that make sense? Sorry, I went on the tangent there, but the timing still matters. The timing does still matter. I used to think it didn't, but it does.
It's interesting because the question is something that seems so simple on the surface, but because of the lack of information that we have about, when it was paid, if they're working, if they're having taxes withheld on anything else, what their tax liability is.
That's what makes
there's lots of what ifs.
That's what makes tax planning interesting, honestly, is it's very personal. There are a number of variables, so every puzzle is unique, and that's what makes it fun to solve.
There you go. You heard it here. All right. Well, next week we will answer some more questions. We have no shortage of them. If you enjoy this segment or these types of things and have questions yourself that you would like us to discuss, please don't hesitate to send them in to podcast@equilibriumfp.com.
Thanks, guys.
Till next time.